Good afternoon, Quasar Markets Live. I hope everyone's having a great afternoon so far. We have the man himself when it comes to covered calls in the house, Dr. Alan Ellman. How are you doing today?
Doing great, despite what the market's doing. I'm upbeat and ready to go, Howard.
I am with you there. It is a rather challenging day today as we get ready for tariffs. We show these videos over again because of the fact that you give such great information that's timeless. So I do want to let people know what we're talking about today is we are 1 or 2 days before tariffs may or may not hit here in the U.S. and around the globe. So everybody's sort of on pins and needles when it comes to the market. And Dr. Ellman, I've got to ask you, I know that you tend to be real risk averse. So I take it that this type of environment for you is not your favorite time to trade, where a lot of people in the option markets love this volatility. If they're selling premium, I have to guess that you maybe not as much.
Well, there's no free lunch out there. So yes,
That's for sure.
when when there's very high implied volatility, when the VIX is getting higher and higher and higher, it is true that the premiums we generate when we sell call or put options is going to be much greater. Well, that's the good news. The bad news is because the implied volatility is what it is. There's a lot more risk to the downside, and that just doesn't align with my personal risk tolerance. I could generate in a low implied volatility environment. I can generate very, very significant annualized returns. And you've probably heard me say this before. The baseball analogy is I
I
never
love it.
seek to hit a grand slam home run. Never. I'm not looking to get 100% returns a year, but I am always looking to hit singles and doubles. So, fairly safe, low risk trades. And the bottom line after years and decades of investing is that it will change your lives from a financial perspective. And
Absolutely.
one other thing I might add, because those of your viewers who are watching these discussions right now may kind of paint everything with one broad brush. The market is horrible. The market is going down. We got to get out of the market. Well, I'm here to tell you that number one, you should only invest when you're comfortable investing. But no matter what the market environment is, you can always find securities that are moving up in a down market. And that's what we do for our premium members. And we're going to be discussing one of those securities in our discussion today that I actually have an ongoing trade that I actually have instituted a few days ago, and that expires on April 17th. So that's just one of the securities that is actually going against the trend of the market. They
And I would
always
say that, right? We've seen a switch into defensive, what we call defensive stocks in the market. And what we mean by that is they're things that tend to be a good protection to a volatile downside. So things like oil and gas companies, energy, communications, utilities. And I know in this case, you're using Royal Gold, as it, again, a gold miner. I will point out that a lot of talk lately from a lot of educators here on Quasar Markets, especially, our gold sort of maven, Peter Thomas, talking about that the gold miners are offering right now about a 3-to-1 move to the upside better than gold itself is moving because just the dynamics. They have low debt ratios right now. There's a lot of good fundamentals behind some of these miners. Are you finding that yourself?
Yeah, these type of securities, um, they have great fundamentals. And let me just throw in another one. I'm not recommending any of these,
Right.
but I'm telling you what I'm investing in. And when we finish this discussion, I'm going to be entering put trades on Wheaton, WPM.
Okay.
That is, yeah, that's also uh, related to this precious metals. It's a Wheaton Precious Metals Corp. And it came up on our report just the other day. And I took a look at it and I decided that this is going to be one of the securities for my portfolio. And
Makes
you brought
sense.
up,
Wow. Nice mover here again. In the non-energy minerals, precious minerals area here, close to its all-time high, but a nice performer you can see since, the first of the year for sure.
yeah, and its fundamentals are great and it's got modest implied volatility like Royal Gold. And I would typically in normal market conditions, which we don't have now, but I would sell out of the money calls. But what I'm going to do with this particular security, I'm going to sell out of the money puts. So I have a little more protection to the downside.
Weird question, not a weird question, but a question I'd have to ask because I know that dividends do not really make a huge difference to you, but you do tend to avoid them a little bit. Will you worry about that tomorrow?
No.
Okay, that's
I just want to the dividend. I do
a
worry about
small
dividend
one from what I saw.
only if it's critical to me that I retain the shares. In other words, if I own a stock at $10 and today it's $100, right? And the most common reason for early exercise is an ex-dividend date. I may, even though it's still rare, I may not want to take a position until the ex-dividend date passes for fear that my shares may be taken away from me. However, I could care less about dividends most of the time. In other words, if the option is exercised and my shares are sold, so some other person can capture that dividend, that means I've maxed out my trade
Yep.
and I now have the cash back, which I could use to start another option selling position in the same contract cycle. Two income streams. So I almost look at it as a positive, with the caveat that if it's critical that you don't lose those shares, you should then avoid ex-dividend days. So I'm not
Okay.
worried about that at all.
Awesome. And we can see they passed earnings here a few weeks ago, so no issues there. So one that Dr. Ellman is definitely keeping his eye on. Now let's get back to the one we did the example of here, and we're going to talk about it. And I thought this was a good subject for us because a lot of newer retail traders have only traded in what let's face it, has been a bull market of since COVID, right?
Yes, 23 and 20, 22 was a down year, 23, 24 were up more than 20% each year. So those that started in, let's say, 23 are probably in shock over
Right.
what's happening here in 25.
Absolutely.
So what I'm going to show you and discuss with you today, Howard, and for your viewers, is a topic you asked me to bring to the forefront here, and that's how do you trade in this kind of a challenging market environment? Because you don't throw in the towel and say it's impossible. It is challenging, but there's ways of doing it, as you'll see in a few moments. But let's state the obvious. It's much easier to make money when the market's going up. I mean,
Right.
exponentially. If the market's going up, or even in a normal market, which is up 8 to 12% a year, the last 30 years, 10 to 12%, well, then we could write out of the money covered calls and generate two income streams: premium plus share appreciation from current market value up to that out of the money strike. Two income streams. But when we sell puts or in the money calls, then there's really only one income stream. So it's much easier to make money when the market is appreciating. But we could still make very good money if the market is going sideways or consolidating. And today's discussion, what about in down markets? And I'm here to tell you that there are ways to do it if your personal risk tolerance will permit. If it doesn't, stay on the sidelines until we have a more normal market. For me, I'm willing to take on a certain amount of risk because I know how to navigate, and I'm sure you do too, Howard, through these kind of markets because we've been through it many times before. So I'm not telling your viewers what to do, but I'm super duper happy to share with you and the Quasar community what I'm doing at this time in this challenging market using raw gold from 328 when I initiated these trades through the 417 monthly April contract expiration.
Awesome. And like we've all said is, we are all pretty much trading during this time. We are all taking different approaches to this market, but as long as you set, and I can't stress it enough, you need to set your stop limits. You need to have your take profits. If you know what they are, if you have your thesis, you want to have these set in. It's as simple as Dr. Ellman's and the Blue Collar Investors 2010 rule, right? You want to lock that stuff in when you make the trade. Too many people are missing right now and are holding losing positions, in my personal opinion, because they're failing to follow one of the big rules that I would call sort of the 10 golden rules of trading, which is, you can't constantly watch the market. So you have to have something in place to do it for you, which in our case would be pre-setting in take profits or stop losses.
Yeah, I mean, management of your trade is just as important as entry of your trade.
Absolutely.
I mean, you can know how to buy a stock, you can know how to sell an option, you can know all that, but once you've executed your trade, it may require management either to mitigate losses, to turn losses into gains, or even to bring your gains up to much higher levels. So those three skill sets are stock selection, could be an exchange traded fund, option selection, and then managing your position. So you're spot on with your comment, Howard. It's really super important to know how to manage your trades before you enter the trade, not,
Right. And that
something.
was what I wanted to bring up, and that's what I was trying to get across is before you enter this any trades right now, you should have in your mind what your thesis is. And this is where my stop loss is going to be, and this is where I'm going to take profit, and this is where I see that stock moving or this ETF moving or this option moving, and therefore I'm going to do the following because it can move quickly. All it takes is one tweet from the White House, and what was a 1% up day can turn to a 3% down day. So you have to be putting these things electronically into the systems. That's all I just wanted to get across. I'm seeing too many people that are sending me notes. Hey, I stepped away. I didn't notice this happened. How can I fix it now? It's much harder to fix after the fact than it is, at the time, and taking just that short haircut and being still in the game, so to speak.
Yep, you're making life simpler for yourself and you're protecting yourself.
Yep.
So
So talk about this challenging market blueprint. How do you approach it?
this is what I'm doing today and for the last 2 months, and probably for the foreseeable future until hopefully things turn around for us. You have to start out with a high quality watch list, and that's from fundamental and technical perspectives. I'll be showing you a little snippet of our stock report and what goes into the screening process for the blue collar investors. And so, step one is to have that high quality watch list of elite performers. So that's number one. Now, as far as covered calls is concerned, I'm no longer doing out of the money covered calls, which is what I would prefer to do for that two income stream potential. I'm not doing that now. Instead, what I'm doing are in the money calls. In the money premiums have an intrinsic value component to it that at the money and out of the money strikes do not have. So that means because there's both an intrinsic value component, the amount that the strike is lower than current market value, plus a time value component, which is based on the implied volatility and the time to expiration. Because there are two components, the break-even price points, as you will see, is much lower. So we're getting protection to the downside with the in the money covered calls, the only kind of covered call that I've been doing recently and over the last 2 months. Now, as far as puts are concerned, we only use out of the money cash secured puts in the BCI methodology. In other words, strikes lower than current market value. But because of the current situation in the market, I'm going deeper out of the money, much lower than current market value, willing to accept lower premiums in exchange for greater protection to the downside. So, what is my goal? Well, if I'm going to do it, I want to get at least an annualized return of 10% or more. Now, if I was doing traditional and normal markets, my goal would be way higher. 2 to 4% a month is what I've been doing for 3 decades now for my initial returns. But today, I'm happy for 10 to 15% annualized returns to get that additional protection to the downside. So what we want to do here is we want to lower our break-even price point. So please, as this discussion progresses, focus in on where our break-even price points are with these type of trades. And I still consider 10 to 15% annualized returns significant, particularly against the backdrop of a declining market.
Absolutely.
And imagine if your local bank had a CD for 12%. Lines
Yeah,
of
and
number
as
five.
you've talked about in the past, is the further you go out of the money on a cash secured put, while you're not making as much in premium, you're getting paid to wait for your entry, if that's what it is, which I love personally. And yeah, I mean, moving them down now makes a lot of sense because you don't want to see it go. If you were at 2 to 4% and now it drops 8%, you're starting at a loss, so to speak.
Right. You have to, that's one of the beauties of these strategies, Howard, is that we can craft our trades to what's going on in the market today. So the
Yep.
type of trades that I'm doing now today, I didn't do any of these in 23 or 24. None of them,
Right. Yep.
you know. And because the market environment is different, and I want to protect myself more, now all of a sudden I'm not doing any of the trades I did the last 2 years, but I'm doing these now until things change.
So important for our viewers to understand that, like we said, is we're not trading the same way we were a year ago. We're not using the same indicators on our charts, those of us that are sort of on the technical analysis side of it. If you are, you're making a mistake. What mattered just a year ago no longer necessarily matters when it comes to indicators. There are indicators that are meant for a one-way market to follow momentum, and there are indicators that look for a market to change. So you got to know trend direction. You got to have different ways that you're looking at the market for sure, like Dr. Ellman is saying here.
Yep.
So
Okay.
why did you choose Royal Gold?
I'm glad you asked, Howard. Okay, I'm going to kind of get a little closer to my screen now so I could see this a little better. But
I'll pull it up a little bigger for you here.
oh, great. Thank you, Howard. Okay, so you'll notice Royal Gold RGLD. This is a little snippet from the 9-page report that we provide to our premium members on the weekends. My team starts working on this when the market closes 4 p.m. Eastern time on Friday, and we usually finish it around 10 to midnight on Saturday, and that's when it's uploaded onto our site. And this is just a little snippet from that 9-page report. So if you start off on the left, you'll see that the ticker RGLD all the way to the left is in bold, where the ones above and below it are not. What that means is all of the technical indicators for trend and momentum and volume were all bullish, despite what's going on in the market. When this report was crafted, all the technical parameters were bullish. So that shows you that this particular security is going against the trend of the market.
Right.
Now, what is the industry segment of Royal Gold? This is in the mining industry segment, which is currently ranked A and was ranked A last week as well. So we could see not only the stock being an elite performer, but the industry that it's in as well is an elite performer. So to me, those factors alone would open my eyes that this may be a security that I would consider. Now, moving over a couple of columns, you will see on the mean analyst rating, or MAR, you will see a number that says 1.82. Now, all the analysts get together and they rate various stocks on a 1 to 5, 1 being the best and 5 being the worst. So when you take an average, a mean analyst rating, a MAR, it's 1.82, which means that its analyst rating is exceptional.
Yep.
Okay, so that's another bullish signal. Now, to the right of that is our on balance volume, OBV, and you could see an up arrow. The trend is up. What that means is more cash is coming into this stock on up days than on down days. And folks, that's another bullish signal. So far, you could see why A, this stock made our list, and B, why I selected it for my portfolios. Now,
Absolutely. I do want to point out something like OBV. What that's telling you, as he said, is we've talked about how the path of least resistance is the one that often stocks choose. So if this one is getting more volume coming in on green days, it means the easiest way is going to be the upside, in my personal take on that.
I agree, and it shows that the institutional investors are also enjoying and
Absolutely.
liking this particular security, and those are the guys that move the market, Howard, not you and me.
That's for sure.
Now you see it has a dividend yield of 1.2%. You mentioned that before. That to me is a non-factor. It may be to others. If I get the dividend, great. If I don't get it, no problem. I've
Right.
matched my trade. I got the money back, and I could reinvest it. Notice that the at the money implied volatility is 26.4%. Now that's modest. It's not super duper high, and it's not like sleepy low.
Right.
So that's the kind of implied volatility that I can work with.
Sure.
I know that with that implied volatility, just based on 30 years of doing this, I know I can achieve both goals: lower my break-even price point and end up with an annualized return between 10 and 15% using this extremely defensive approach to covered call writing. So you could see in the open interest that yes, there is adequate liquidity with this particular stock, and that's important. It's been on our premium watch list for 5 weeks. After the report from 2 days ago that we just published, it's now 6 weeks. And the ex-dividend date, which I have is 4/4. I guess you have it as,
Trading View had it as April 1st, but Trading View is not always accurate.
yeah. Okay. So anyway, we know it's coming up before expiration of the April contracts. Not a factor for me. So that's why RGLD made our very stringent screening process, and why I selected it for two of my portfolios for the April.
Absolutely. And for those that don't know, Royal Gold is a gold mining company. So in general, they mine other things, but gold is their number one, product.
Okay, so
Okay,
this
so
is
let's look at the option chain here.
yeah, this is the option chain. I told you it's for the April 17th, 25 expirations. Now, in the money for calls on the left side would be strikes lower than current market value. So I selected the 155 strike, and you can see on the left in the purple cell, and the bid price was $8.60. Now, is that all profit? No, it's not. Why? Because are we not losing $7.54 on the sale of the stock? We bought it at 162.54. We're agreeing to sell it for 155. So that 754 must be deducted from the 860. Our spreadsheets will do that for you. You don't have to worry about the math. But just to say, the actual time value profit is not 860. Okay. Now that's what I selected for the in the money covered call. And will it do the 10 to 15% annualized returns? We'll see.
Yep.
Now let's move over to the right side, Howard, with the puts. Now, for an out of the money cash secured put, that would be also lower than current market value. So I selected the same 155 put strike. And you could see here that had a bid price of $1.25. So wait, that seems like way less than the premium we got from the in the money call, but this is all time value. There's no intrinsic value component to it. So as you're going to see, the time value on both are going to be pretty much the same, or very similar anyway. And you
Right.
could see that okay, let me just add something that I wasn't planning on talking about, but your viewers might be interested in this. Take a look at the delta figure on the right side puts. It's 22.6%. That means that the probability of expiring in the money, in other words, Royal Gold dropping from 162.54 to below that 155 strike, is about 23%. So there's 77% probability that won't happen. So the odds are greatly in our favor with this trade, with this particular strike. Now, that doesn't even count what you alluded to before, which were our exit strategy arsenal in case the trade does in fact turn against us. And you'll notice on the left side, if we could just look at the delta for the call, is 78%, which means that there's a 78% chance that it will remain in the money, which for calls we want. We don't want that turning to an out of the money strike by Royal Gold dropping from 162.54 to below that 155 strike. So they're high probability trades. Is there risk? Yes, but the risk is low. Okay, so Howard, this is the calculations for the in the money covered call, which if we look at the top row with the trade entries, 162.54, the 155 in the money call for 860. We just showed you that. Now, take a look at that broken red arrow. What I wanted to bring to the attention of your viewers is that we are lowering our break-even price point from 162.54 if we just bought the stock down to 153.94. And as I calculated on the top in those yellow words on the top, that's a 5.29% to break even. So that means that if Royal Gold does not drop by more than 5.29% in the 21-day trade, we will not lose money.
Right.
Right? So that's the degree of protection. Now, what about the actual returns? Are we going to get our 10 to 15% target? Well, in the brown cells, you see that the time value component, which in the second column from the left bottom is $1.06. Out of that 860, $1.06 is time value. The rest is intrinsic value. So that computes to 0.68% in the brown cells, and based on a 21-day trade, annualizes out to 11.89%. So we're between our 10 to 15% target.
Yeah, absolutely.
Right? So that's the high probability of success, lowering our break-even price point about $8 and change, and again getting our target return. So that's the in the money call. We can move on to the out of the money put.
Okay.
Same entries on the top, 162.54. Same strike. You remember it was $1.25. All time value. So you could see here with the spreadsheet, if we look at that broken red arrow again, we're now protected from 162.54 to our break-even price point of 153.75, and that's a 5.41% to break even, as I have on the top and in the purple cell on the bottom right. 5.41%, just a little bit better than the in the money covered call, but we're in the ballpark. They're pretty much the same break-even price points, and in this particular case, the returns are just a drop higher, 0.81%, 14% annualized. So one was 12% annualized, one was 14% annualized, both within our target range of 10 to 15%, both substantially lowering our break-even price points, and once again structuring our trade such that we can accomplish both goals, 10 to 15%, and substantially lowering our break-even price points. And these are the kind of trades that I've been doing now for the last 2 months or so.
Absolutely. And I did want to go back one just to point out that, the deltas are almost inverse. They're not exactly, not exactly, but pretty close.
Oh, very close. Very close.
So it also gives you about the same predicted result, right? Or close to the same prediction of percentage of ending up in the money on either of them.
Yeah, for your viewers, you can use delta to actually quantify the risk you're taking in these trades.
Absolutely.
It's one way of doing. We can also use implied volatility. I think I've discussed that. But delta is a really, really easy way to quantify the risk in the trade, and then you could weigh that against the returns and see if that fits your personal profile.
Yep, that's what's so important. So let's bring this all together. I think that is so important, is having flexibility, understanding that the market that we trade is not the same every single day, and we need to be nimble, right?
Howard, when I started teaching myself these strategies in the mid-1990s, they all used to say the same thing, that covered call writing is good in sideways markets. And you buy a stock and you write a slightly out of the money call. There was very little on management. But that's simply not true. We have the ability to craft our trades based on what's happening today. And what's happening today is very different from what was happening the last 2 years. New investors, if they learn how to invest in these kind of markets and get comfortable with it, well, then they're never going to get frightened again. They're going to be saying, oh, yeah, I remember in early 2025, the market was down more than 5% in 2 months. I was panicking then, but now I know what to do. I'm going to focus in on in-the-money covered calls. I'm going to focus in on deep out-of-the-money cash secured puts. I'm going to measure my risk tolerance so it's no greater than 25%, or whatever fits your particular need. Once you do that and you throw in that you know how to manage trades if they turn against you or end up much better than you're anticipating, well, then you could sit back, relax, and have years and decades of benefiting from these great income-generating strategies.
Absolutely. So we're to your final discussion.
Yeah. So I think I covered, the
Hit
in the
most
money
of it.
calls, the out of the money puts. But let me just get a little philosophical here, because when we sell in the money calls or deep out of the money puts, I view these as insurance policies. We all
Right.
have insurance policies, right? I mean, we have homeowners, we have car insurance, medical, whatever. We have all these different insurance policies. What do they all have in common? We pay for them. We have to write a check. Oh, look, my life insurance policies do. You write a check. But this particular insurance, protection to the downside, when we're selling options, is the one insurance policy that we don't have to pay for. Why? Because it's paid for by that guy over there, the option buyer, in the form of
Absolutely.
intrinsic value or the premium paid for the deep out of the money cash secured put. So why not take advantage of those free insurance policies that are offered to us as retail investors? I mean, institutional guys may do this to some extent as well, but not as good as us retail investors,
That's right.
I might add. based, based on,
Absolutely. They get too many they get too much, risk neutral type things they're trying to do.
well, also based on the covered call ETFs I've seen and so on and so forth. But
They don't do it very well at all. Yeah, those
no,
have been a disaster
we,
all
we
across.
retail investors can do it way better. And so,
Absolutely.
but yeah, it's an insurance policy that we should all take advantage of in these kind of market conditions, please.
Absolutely. Such great advice from Dr. Ellman, like always. Thank you so much for joining us here at Quasar Markets Live. And Dr. Ellman, thank you so much for sharing your knowledge. It's going to be an interesting couple of days here. We'll see how it plays out, and we'll be back next week to discuss a little bit more about it, right?
My pleasure, Howard. I'll see you then.
See you then.